How to financially prepare to buy your first home. Hi there, it's Luigi and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we're gonna share with you some tips and tricks to help you financially prepare to buy your first home. Buying a house is often the largest purchase you will ever make, and that's why planning your finances can provide you with a substantial advantage. For example, if your credit score is good enough, you may be able to obtain more competitive mortgage rates from lenders. Aside from the down payment, there are additional expenditures associated with the house purchasing process. While the majority of emphasis is focused on preparing a sizable down payment, there's more to it than simply your mortgage payments. Lenders consider indicators like income and debt-to-income ratio, but your credit score is also important. Your credit report determines your credit score. Experian, Equifax, and TransUnion each provide you with 3 credit reports and scores. Given how things are weighted, if you want to have the most influence on your credit score, you should concentrate on your payment history and debt management. The first step is to obtain a copy of your credit report and double-check its accuracy. Believe it or not, there is a potential that your report contains an error. In fact, it's believed that more than 20% of people have an error in their credit report. While it may seem like a little thing, such as a misspelled name, any errors with your payments, or showing an open account that isn't yours, it still may be disastrous. You should always bear in mind that lenders will look at your finances to see whether you can afford a mortgage, so make sure your debt-to-income ratio is modest. Paying off high-interest bills may be a tremendous relief. If they are credit cards, you may wish to keep the accounts open at least until you've purchased your home. Lenders often reward customers who have unused lines of credit. To avoid the temptation to use it, keep your credit cards in an inconvenient but secure location around your home. Now that your credit report is correct and your credit score has improved, it's time to move on to the next phase in financial planning: determining how much house you can buy. In addition to having your mortgage lender determine how much you can afford, you should run the numbers yourself. You want to buy a property, but you also want some money left over to enjoy it and pursue other objectives like furniture and other house essential stuff. You won't be able to attain them if your house budget is exhausted. You must determine what you're comfortable with in order to be a homeowner while meeting your goals. So how do you determine how much home you can afford? The general guideline is that your mortgage should be no more than 2.5 to 3 times your yearly income. Assume your family's annual income is $65,000. Using that as a guideline, you would be looking at properties priced between $163,000 and $195,000. If you have a family of 4 earning $120,000, you may go house searching between $300,000 and $360,000 and still have money left over for other ambitions. One of the most important reasons for a greater down payment is to avoid paying private mortgage insurance, or PMI. This provides lenders with more comfort about the money they're providing, but it might be an unneeded burden on you. Begin automatic transfers into savings with each payment, even if the amount is less than you had intended. You may then increase your down payment by diverting any unexpected money, such as a bonus, stimulus check, or tax return, into your savings. Having a larger savings account might be really beneficial when purchasing a property. The Consumer Financial Protection Bureau advises acquiring loan estimates for the same type of mortgage from different lenders in order to evaluate costs such as interest rates and possible origination fees. Lenders may give the option to purchase discount points, which are payments paid beforehand by the borrowers to decrease the interest rate. Purchasing points might make sense if you have the money and want to stay on the property for an extended period of time. Next, you can get a mortgage pre-approval letter. A mortgage pre-approval is a lender's offer to lend you a certain amount under certain conditions. A pre-approval letter informs house sellers and real estate brokers that you're a serious buyer, and it can offer you an advantage over other home searchers who haven't yet taken this step. When you're ready to start looking for a house, apply for pre-approval. To verify your income, assets, and debt, a lender will run your credit and evaluate documentation. Applying for a pre-approval from several lenders to shop prices should not harm your credit score as long as you do it within a specific time range, such as 30 days. Another tip is to find a good real estate agent. A professional real estate agent will scan the market for houses that fit your requirements and will walk you through the negotiating and closing process. Obtain agent recommendations from other recent property purchasers. Request references from at least a few agents. When chatting with possible agents, inquire about their experience working with first-time home buyers in your area and how they intend to assist you in finding a property. Now it's time to choose the appropriate house and neighborhood. Given your lifestyle and budget, weigh the benefits and drawbacks of various types of residences. A condominium or townhouse may be less expensive than a single-family home, but it will have less privacy due to shared walls and neighbors. When looking for condominiums, townhouses, or houses in planned or gated communities, don't forget to factor in homeowners association costs. Another alternative is to purchase a fixer-upper, which is a single-family home that needs upgrades or repairs. Fixer-uppers often sell for less per square foot than ready-to-move-in homes. You may, however, need to budget for repairs and remodeling. Renovation mortgages combine the cost of the house and the cost of upgrades into a single loan. Consider your long-term needs, and if a starting house or a permanent home will best suit them. If you want to establish or expand your family, it may make sense to purchase a home with additional living space. Thoroughly investigate possible neighborhoods. Choose one with features that are vital to you. Then try out the commute during peak hours. You can also attend open houses or even pay for one just to make sure you are getting your dream house. During the COVID-19 epidemic, online 3D home tours have grown in popularity. These tours allow customers to virtually walk around a property at any time and see nuances that conventional images miss. They don't provide all of the information that in-person inspections provide, such as how the carpet smells, but they can help you narrow down your selection of places to view. When visiting homes in person, use all of your senses. Pay attention to any scents and the overall condition of the residence, both inside and out. Inquire about the kind and age of the electrical, plumbing, and roofing systems. A house inspection is a comprehensive examination of the structure and mechanical systems. Professional inspectors check for any issues so you can better make an educated decision about purchasing the property. Standard inspections don't test for things like radon, mold, or pests. Understand what's included in the inspection and what other inspections you might need. Ensure that the inspector has access to all areas of the house, including the roof and any crawl spaces. You don't want some icky crawlers at your new house. Yikes! The last tip is to try and negotiate with the seller. You may be able to save money by requesting the seller to pay for repairs in advance or by lowering the price to cover for the cost of future repairs. You might also request that the seller pay some of the closing fees. However, keep in mind that lenders may limit the number of closing fees that the seller can pay. Your bargaining strength will be determined by the local market. When there are more buyers than available properties, it is more difficult to drive a hard deal. Work with your real estate agent to learn about the local market and plan accordingly. And that's it for today's video. We hope you learned a couple things, and if you enjoyed it, don't forget to like, subscribe, and hit that notification icon so you can be notified whenever we upload new videos. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.